Hey everyone, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today's episode is something I'm really excited to dive into. We're going to unpack a topic that separates casual traders from professionals: how to trade like a quant. If you're already exploring advanced trading strategies, or you're knee deep in options trading strategies advanced, but you haven't fully embraced quantitative methods yet, trust me, you're missing out on a huge edge. Today, I'm going to walk you through how to analyze data like a quant, how to build your strategies on real, testable logic, and how to get started without needing a PhD or a Wall Street job. Let's get into it. Why quantitative trading? So, why should you even care about quantitative trading? Quantitative trading, or quant trading for short, uses math models, statistics, and computer algorithms to uncover and exploit trading opportunities. Unlike discretionary traders who might rely on gut instinct or visual chart patterns, quants make decisions based on data, rules based systems backed by hard evidence. And here's the best part: this isn't just for the suits in hedge funds anymore. With today's tools, algorithmic trading for beginners is totally within reach. You don't need a fancy math degree to get started. What you do need is curiosity, discipline, and the patience to test and refine your ideas. Retail traders like us are now using cloud based tools, open source libraries, and online communities to build strategies that stand shoulder to shoulder with institutional grade systems. So, yeah, it's time to stop guessing and start quantifying. Core concepts every aspiring quant should know. Backtesting, the scientific method for traders. Let's kick things off with backtesting, the absolute cornerstone of quant trading. Backtesting is when you take a strategy, apply it to historical data, and see how it would have performed. It helps you validate whether your idea has real merit. Done properly, it reveals whether your concept works, how risky it is, your win/loss ratio, whether it's been overfitted to past data. Picture this: you create a strategy that buys SPY when the 10-day moving average crosses the 50-day. Backtesting it over 10 years tells you if that crossover consistently led to gains, or just looked good on paper. But here's your warning: avoid overfitting. That's when your strategy is so fine tuned to past data that it falls apart in real trading. Always use techniques like out of sample testing and walk forward analysis to keep your models honest. Probability and edge. Next up is the language of all great quants: probability. Quant trading isn't about being right every time. It's about having a consistent edge over time. Even if you win only 55% of the time, you can be profitable if your winners are bigger than your losers. So instead of asking, will this trade win? Start asking, what is the expected value of this setup? That's a huge mindset shift. This is where concepts like Sharpe ratio, risk reward, and expectancy come into play. Some pros use advanced techniques like Monte Carlo simulations and Bayesian statistics, but you don't have to get that technical right away. Just start thinking in odds. Think like a casino, not a gambler. Factor investing, betting on patterns in data. Let's talk about one of the most powerful ideas in modern investing: factor investing. Factor investing means building portfolios around traits that have historically outperformed. Some of the most common factors include value. Undervalued stocks tend to outperform. Momentum. Winners often keep winning. Quality. Strong, profitable companies tend to perform better. Low volatility. Low-risk stocks often beat high-risk ones over time. You can build strategies around one or multiple of these factors. Platforms like crystalballmarkets.com let you easily backtest and combine them. You're no longer throwing darts, you're building a system grounded in repeatable logic. Statistical arbitrage, finding mispricings. Now, let's get a bit more advanced. Ever heard of stat arb? Statistical arbitrage, or stat arb, is a market-neutral strategy that profits from temporary mispricings. A classic example is pairs trading. Think Coke and Pepsi. If they usually trade together but suddenly diverge, a stat arb model might short one and long the other, betting they'll converge again. To find these setups, quants use co-integration tests, z-scores, and other statistical tools. Don't worry, you can start small with spreadsheets or Python scripts and still find real opportunities. Tools of the trade. You're probably wondering, what tools do you need to trade like a quant? Let me break it down. Python, hands down the best language for quants. Use pandas, number PY, and matplotlib for analysis. Backtrader slash quant connect, amazing for backtesting and paper trading. Excel plus VBA, old but still gold for quick models. Crystalballmarkets.com, this one's fantastic for automating strategies and visualizing data. A top pick for the best trading software for advanced traders. If you're starting from scratch, I recommend Python. It's user-friendly and incredibly powerful. Starting small, building your first quant strategy. All right, so how do you actually build your first quant strategy? Choose a market, start with what you know. Stocks, ETFs, or options. Develop a hypothesis, like stocks that rise 3 days in a row tend to mean revert. Gather data. Use Yahoo Finance, Quandl, or your broker's API. Backtest it. Test across years of data. Check metrics like CAGR, Sharpe ratio, drawdowns. Refine. Adjust your parameters. Try different filters. Look for consistency. Pay per trade. Test it live without risking cash. Watch how it performs in the real world. This test, refine, test again loop, that's the quant trader's mantra. Real world example, options volatility edge. Here's a real world example using options. Say you notice that implied volatility spikes before earnings, but actual moves are smaller than the market expects. That's an edge. So you build a strategy to sell straddles during earnings when 4 is high but actual movement is low. Add filters, 4 rank, earnings history, delta range. Use a platform like crystalballmarkets.com to backtest the strategy over multiple stocks and cycles. Now it's not a hunch, it's a system. Integrating global macro thinking. Quants don't ignore fundamentals. Many blend global macro investing ideas into their systems. For example, if global PMIs are rising, you might go long commodity currencies. Or if inflation expectations are heating up, you short bonds. The key is building rules around macro indicators, then testing them. This way, you're not reacting to news, you're executing a strategy that's already been stress tested. Where to learn more? Want to go deeper? Subscribe to the Crystal Ball Markets podcast. It's perfect for anyone exploring algorithmic trading podcasts or looking to learn more about AI and stock trading. Every episode is packed with insights that are accessible, actionable, and actually fun to listen to. Final thoughts, why this matters. Here's the truth. Trading without data is just gambling. Quantitative methods bring structure, discipline, and objectivity to your process. Whether you're a discretionary trader looking for more consistency or a coder curious about finance, quant thinking will elevate your game. Start small. Test your ideas. Track everything. And stay humble. If you're ready to upgrade your process, I highly recommend crystalballmarkets.com as your go-to quant-friendly platform. Trade smarter. Trade like a quant. Thanks for tuning into Financial Market Insights for Traders. I'm Sophia, and I'll catch you in the next episode.